Ever heard of short selling? It's a financial term. Now you know. Did you know it had a spicy history? The story of the first stock ever to be shorted actually tells a tale of intrigue, lies, sabotage, and a life of exile. But maybe the spicy history story time will be for another day. In this video, we are going to be showing you the basics of short selling. Let's get started. Short selling, also known as shorting, selling short, or going short, is the selling of a security or financial instrument for which the seller has taken out a loan. The short seller anticipates that the price of the borrowed security will fall, allowing it to be repurchased for a profit at a lower price. The profit, or loss depending on the situation, made by the short seller is the difference between the cost at which the asset was sold short and the value at which it was purchased. Short selling is among the most misunderstood aspects of the investment world. In fact, short sellers are sometimes derided as dishonest individuals who are just interested in making a quick buck at any cost, regardless of the company's or livelihoods lost in the process. Worse, since they are wagering against the economy, some critics have dubbed short sellers as unethical. However, the truth is quite the opposite. Rather than being cynics who want to prevent individuals from obtaining financial success, short sellers actually help the markets work smoothly by providing capital and also acting as a check on investors' overconfidence. Although this practice draws unethical operators who may use unethical tactics to drive down the cost of a company, this is not dissimilar to stock promoters who use excitement in pump and dump tactics to drive up the price of a stock. With the presence of hedge funds, quant funds, and other investors on the short side, short selling has arguably acquired more acceptability in recent years. Investors' desire to learn about short selling as a technique for managing portfolio risk has increased as a result of the emergence of two ferocious global bear markets in the first decade of this millennium. Short selling can actually help protect investors from financial fraud by disclosing corporations that have cheated the system by inflating their earnings. On the whole, they do their homework and investigate properly before taking a short position. Such research frequently uncovers information that isn't easily available elsewhere, especially from brokerage firms that tend to offer purchase rather than sell recommendations. How short selling works. To short a stock, you'll first need an account with a brokerage firm. Next, you'd have to deposit a specific amount of margin into this account. The normal profit margin is 150%, which means you'll need to come up with half of the profits you'll make from shorting a stock. So, if you want to short sell 100 shares of a $10 stock, you'll need $500 in your account as margin. Let's imagine you've established a margin account and are now hoping for a nice candidate for short selling. You determine that Shmoney Co., a fictional corporation, is on the verge of a significant drop and chooses to short 100 shares at $50 each. Firstly, the short sale order is placed using your online trading account or with the help of a financial advisor. It's important to note that you must declare the short sale since an unregistered short sale is a breach of securities laws. 2. Your broker will try to obtain the shares from a wide range of sources, including the brokerage's portfolio, one of its clients' margin accounts, or another broker-dealer. Before performing a short sale in any asset, the Securities and Exchange Commission, SEC, needs a broker-dealer to have legitimate cause to think that the security can be borrowed, such that it can be given to the buyer on the due date. It is known as the locate requirement. 3. The shares will be sold to the public and then proceeds placed in your margin account once the broker-dealer has borrowed or located them. Typical short sellers. Hedge funds. Hedge funds are among the most active participants in the shorting market. The majority of hedge funds strive to mitigate market risk by shorting equities or industries that they believe are overvalued. Hedgers. Hedging, which is not to be mistaken with hedge funds, usually entails an offsetting position in a similar security to lower the risk exposure in the initial investment. As a delta hedge, if someone is along the market using choices or future contracts, they will short sell the underlying assets. Individuals. Short selling is also used by sophisticated investors to manage market risk or merely for speculation. Speculators do make up a sizable portion of the short market. Another important element of the short side is day traders. Short selling is best suited to very short-term investors who have the financial means to maintain a close check on their positions and the trading knowledge to make swift judgments. Risk and rewards. Payoff with a skewed risk-reward ratio. A short sale, in contrast to a long position in a security, where the decline is restricted to the extent invested in the security and the potential profit is limitless, at least in theory, carries the theoretical risk of infinite loss, while the gain margin would occur if the stock drops to zero is limited. Shorting is costly. Aside from trading commissions, short selling entails a variety of expenses. Raising shares to short sell requires a hefty cost, in addition to the interest that is generally paid on a margin requirement. Contrary to popular belief, as previously stated, short selling runs counter to the market's established rising tendency. The vast number of shareholders and other market players are long only, resulting in natural impetus in one direction. All about the timing. The timing of a short sale is crucial, as starting a short sale at the incorrect moment can be disastrous. Because short sales are done on margin, if the price rises instead of falls, you can lose money fast as brokers demand that the sales be repurchased at progressively higher prices, resulting in a short squeeze. Risks from regulations and other factors. Short sales are occasionally prohibited by regulators due to market conditions. This can produce a spike in the markets, causing short sellers to cover positions at a significant loss. Stocks that are widely shorted are also at risk of being bought in, which refers to a broker-dealer closing out a short position if the stock is extremely expensive to obtain and its creditors are demanding it back. Because of the numerous hazards connected with short selling, it is only appropriate for traders and investors who have the financial discipline to reduce their losses when necessary. It is not a feasible strategy to hold on to an unsuccessful short position in the hopes that it will recover. In addition, this practice necessitates ongoing position monitoring and strict adherence to stop further loss levels. Common questions about short selling. When does short selling make sense? Short selling is not a popular practice among investors, owing to the belief that equities would appreciate in value over time. The stock market in the long run tends to rise, yet bear markets, in which equities fall sharply, occur from time to time. Buying stocks rather than short selling is a safer bet for the average investor with a long-term investing plan. Short selling may only make sense in certain circumstances, such as during a prolonged bear market or when a company is in financial distress. Basically, it should only be attempted by sophisticated investors with a high risk tolerance and a thorough understanding of the dangers involved. Alternatives to short selling that are less risky. Buying a put option on the same stock is an alternative to short selling that restricts your downside risk. The investor who owns a put option has the right, but not the responsibility, to sell the underlying security at a certain price, known as the strike price. If the stock price rises instead of falling, the investor's loss is restricted to the extent paid for the put option, known as the option premium, plus additional commissions. The premium on a put option will vary depending on the strike price and the expiry date. The option premium will be higher if the strike price is higher and the expiration date is further in the future. What is the maximum amount of money a stock short seller can make? Because the cheapest cost at which a stock can trade is $0.01, the highest profit you can possibly gain from short selling a stock is 100%, after factoring expenditures associated with the short position, such as stock borrowing costs and margin interest. The actual profit on a successful short transaction is likely to be less than 100%. Is it harmful to the economy to short sell? Because some dishonest short sellers have employed unethical strategies to push down stock prices, short selling has taken on a negative image. When done correctly, short selling actually helps financial markets run smoothly by providing market liquidity and acting as a dose of reality for investors' unreasonable expectations, minimizing the likelihood of market bubbles and allowing negative risk mitigation. What is the difference between short selling and regular investing? Shorting a company comes with its own set of restrictions that differ from conventional stock investment, such as a rule that prevents short sellers from driving down the price of a stock that has declined more than 10% in one day, compared with the previous day's closing price. In principle, the risk of a short sale resulting in a loss is limitless. The price of a stock could continue to climb indefinitely. This is why short selling is best done by experienced traders who are aware of and comprehend the dangers. How can you profit from a company that is losing money without short selling the stock? Options and inverse ETFs are two of the most prevalent ways to make money from a stock's decrease without shorting it. When you buy a put option, you get the right to sell a stock at a specific strike price. Therefore, the buyer is hoping for a drop in the market so they can sell at the strike price and make more money. SQQQ, for example, is an inverse exchange traded fund, ETF, that goes in the reverse way of QQQ. If you feel the price of QQQ shares will fall, you can profit from a drop by shorting QQQ, buying a call option on QQQ, or buying shares in SQQQ. Is it true that shorting a stock lowers its price? A single short sale order is unlikely to have an impact on the price, regardless of whether a short seller or a buy and hold investor decides to sell after decades of holding the company. All selling exerts downward pressure on stock prices. If a large number of people sell at the same time, regardless of whether they are short sellers or not, the stock price will fall. What is the polar opposite of selling a stock short? Going long is the total opposite of shorting a stock. A purchase order, as opposed to a sell order, is how dealers refer to establishing a position with a buy order. In other words, buying a stock is the polar opposite of shorting it. And there you have it, folks. Now that we have discussed a few basics of short selling and what it entails, let us know in the comment section down below your thoughts on it. Would you be interested in short selling? Do you think more and more people will be inclined to participate in the future? Nevertheless, remember to always do your research and make the most of your resources. If you found this video helpful, feel free to leave a like and subscribe to our channel for more videos just like this one. See you in the next video.